Assalamualaikum and hi. Today I will be presenting about summary of MFRS 9. MFRS 9 is a financial instrument standard issued by MASB and is the Malaysian version of IFRS 9. It became effective on 1 January 2018, replacing MFRS 139 because the old standard was too complex and seemed hard to understand. Under this standard, financial assets are classified based on the business model and the SPPI test, and they are measured at the amortized cost, FVOCI, or FVTPL. Financial liabilities are usually measured at amortized cost unless they are designated at fair value. One of the main features of MFRS 9 is the expected credit loss model, which is require companies to recognize credit loss earlier using a forward-looking approach. The standard also improved hedge accounting so that it better match an organization's actual risk management activities. Overall, MFRS 9 aims to give users more relevant and transparent information about the financial instrument and the risk involved.
Hi, my name is Nabila. My metric number is 300803. I will explain the accounting theory that helps us understand the development of MFRS 9, which is the Malaysian Financial Reporting Standard for Financial Instrument. MFRS 9 was developed to improve the reporting of financial instrument. Its key features include classification and measurement of asset and liability, hedge accounting, and the forward-looking expected credit loss model for impairment. This feature aim to enhance transparency and reliability in financial reporting. First, normative accounting theory focus on how accounting should ideally be done. MFRS 9 select this theory through the expected credit loss model, which require recognize potential credit losses before they occur. This ensures financial statements provide relevant and reliable information for decision making rather than waiting for losses to happen. Second, positive accounting theory explains accounting based on actual practices. MFRS 9 was influenced by deficiencies in MFRS 139, where losses were recognized too late. Observing how company and market responded to risk, the standard was developed to reflect realistic and practical reporting methods, aligning with the behavior of firms in the industry. Finally, regulatory accounting theory emphasizes the role of standard setters like the MASB. MFRS 9 align with IFRS 9 to ensure transparency, comparability, and stakeholder protection. By providing clear rules on classification, measurement, and impairment, the standard enhances confidence in financial reporting and promotes financial stability. In conclusion, the development of MFRS 9 is influenced by three key accounting theories. Normative theory ensures perspective and decision useful reporting. Positive error theory reflects actual practices, and regulatory theory focus on governance, transparency, and stakeholder protection. Together, this theory explains the rationale behind the formulation of MFRS 9.
Now, I will explain the main parties involved in the development and formulation of MFRS 9. At the international level, the most important body is the International Accounting Standard Board, or IASB. IASB is responsible for developing IFRS 9, which forms the basis of MFRS 9. They carry out extensive research, issued exposure drafts, and gathered global feedback, especially after the 2008 global financial crisis. The IASB introduced the expected credit loss model and made major improvements to replace IAS 39. Since Malaysia adopts IFRS fully, their decision directly influence our MFRS 9. Next, at the Malaysian level, the key body is the Malaysian Accounting Standard Board, or MASB. MASB reviews IFRS 9 to ensure that it is suitable for the Malaysian environment before officially issuing it as MFRS 9. They also engage with local stakeholders, consider feedback from regulators and companies, and also make sure that the standard complies with Malaysian regulations such as the Companies Act. MASB plays a crucial role in bridging the international standard to local practice. Besides the standard setters, several other parties were also involved. Industry players such as banks, insurance companies, GLCs, and public listed companies contributed significantly. Because MFRS 9 introduced major changes in impairment and classification, these companies participated in field testing, provided practical insight, and helped identify challenges in applying the expected credit loss model. Their real-world feedback shaped the way the standard was refined and implemented. Next, we have the regulators, including Bank Negara Malaysia, the Securities Commission, and also Bursa Malaysia. These bodies assessed how MFRS 9 impact financial stability, regulatory capital, and investor protection. Bank Negara in particular issued guidelines, provided transition arrangement, and worked closely with MASB to ensure compliance among financial institutions. Their involvement ensured that adopting MFRS 9 did not create instability in the financial system. Other important contributors include professional accounting bodies such as MIA, SCCA, and CPA Australia. This organisation provided technical guidance, offered training programs, and submitted comments during the exposure draft stage. Their role ensures that accountants in Malaysia are prepared to apply MFRS 9 correctly. Academia, including universities and accounting researchers, also played a part by analysing the proposed standard, conducting academic studies, and providing theoretical input. They also help prepare future accountants through education and curriculum updates. Last but not least, we have audit firms, especially Big Four, such as PwC, EY, Deloitte, and also KPMG. These firms carry out technical assessment, identify implementation challenges, and assisted companies transitioning from IAS 39 to MFRS 9. Their expertise ensured that the standard is not only theoretically sound, but also practically and auditable in real-world application. Overall, the development of MFRS is a combined effort between international standard setters, local authorities, industry players, regulators, academic, and professional experts.
Next is the nature of the MFRS 9. MFRS 9 is a principle-based accounting standard, meaning it relies on broad concepts instead of detailed rules. This approach was introduced because IAS 39 was considered difficult to understand and apply. Many users also urged the IASB to create a standard that was clear and less complex. The move from IAS 39 to MFRS 9 reflects the needs for a more flexible and judgment-based system. Under MFRS 9, entities must use professional judgment when managing financial assets, assessing whether cash flow meet the SPPI criteria, and estimating expected credit losses. By using a principle-based structure, MFRS 9 provides more flexibility and support better decision-making, while ensuring that Malaysia financial reporting remains aligned with international best practice and fully compliant with IFRS.
Hi, my name is Nazra Nojifa and my metric number is 300865 and I will present to you on limitation of MFRS 9. The first one is complex classification and measurement. MFRS 9 is very complicated and enters a lot of equation, especially when it comes to placing and measuring financial asset. Both the business model and characteristic of the contractual current of cash flow have to be assessed by the SPPI test, which may be challenging when financial instruments have BM features or non-standard terms. This complication heightens the chance of misinterpretation and failure to use them in various organizations. The second one is subjective SICR assessment. MFRS 9 is challenging to establish whether a financial asset has suffered a significant increase in credit risk SICR. The evaluation involves the tracking of too many qualitative and quantitative data, including payment behavior, credit rating, and macroeconomic factors. Due to the absence of specific limit and guidelines stipulated in the standard, an entity can follow varying criteria and method. This subjectivity influences the recognition of timing and quantity of impairment, resulting in diminishing comparability among entities. The last one is challenging Hedge accounting requirement. Hedge accounting under MFRS 9, though it is more consistent with risk management practice than previously, it is still complicated. Organizations are required to keep detailed records on hedging contract, risk management goals, and effectiveness measure. Monitoring should be done continuously to take care of the hedge, and deviation in should be corrected in time. In organizations that have simple treasury operation, this condition can often prove difficult and deter the hedging accounting, where the latter would give a better representation of the economic hedges. Based on those three limitations that have been highlighted in 5.0, there are suggestions or recommendations to overcome those limitations. The first one is the complexity of MFRS 9 can be overcome by investing in regular training and upskilling of the accounting and finance staff of company. Misinterpretation can be minimized by appropriate technical workshop, counseling by professional association like MIA, and by use of elaborate implementation manuals. Also, the firm can formulate internal regulation and trust framework to use the business model assessment and SPBI test consistently. The error can be minimized as well by using specialized accounting software and consulting external experts during the first implementation. Entities can be able to implement the standard more consistently and confidently by reinforcing internal competency and improving documentation practice. Next, in order to enhance the evaluation of SICR, organizations are recommended to set specific internal policy as well as quantitative this used to measure credit deterioration. This may involve setting of day past due limit, credit rating trigger, or financial ratio indicator. Automatic credit monitoring systems are also supposed to be adopted by companies that would follow the behavior of borrower in real time and alert about possible SICR event on a regular basis. Accuracy can be enhanced by regularly revising the SICR criteria as the past performance and market condition. The application of structured, clear, and frequently revised criteria would enable organizations to increase the consistency and reliability of SICR assessment. Lastly, in order to cope with the complexity of hedge accounting and MFRS 9, they are advised to enhance their treasury and risk management department. The compliance process can be made easier by offering specialized training to the staff and creating elaborate internal documentation template. The entity can also use less complex forms of hedging that are simpler to record and track at the same time achieving the business requirement. The administrative load can be minimized by effectual testing and regular basis with the help of automated tools or treasury management software. Company can also utilize hedge accounting more efficiently and with reduced incorrectness by enhancing the internal process and making sure that hedging objective.
Hi, my name is Noriana Shafika. My matric number is 301000 and I'll be sharing a brief reflective statement on what we have learned from this comprehensive case. First, let's look at the academic and technical knowledge that we gained. This project allowed us to develop a thorough understanding of the complex rules and regulation of one of the accounting standards, which is MFRS 9. We also learned that the formulation of MFRS 9 is actually influenced by the theoretical principles, specifically normative, positive, and regulatory theories. Next, we discovered that MFRS 9 was a collaborative effort involving a diverse range of main parties such as ISP, MSP, industry players, regulatory authorities, professional accounting organizations, and also auditors. And finally, by examining the standard, we can clearly see that MFRS 9 follows principle-based accounting standard which prioritize broad accounting concept over rigid and specific rules. Moving on to our critical analysis and problem-solving experience. So through our analysis, we acknowledge several limitations within MFRS 9. These are particularly visible in areas like credit risk assessment, monitoring hedge effectiveness, and the complexity involved in the categorizing and measuring financial assets. Based on this limitation, we were able to formulate practical recommendations. This includes suggestions for regular training, developing clear internal process, and enhancing the treasury and risk management departments. Lastly, let's reflect on the teamwork and professional skills that were sharpened during this process. Firstly, working on this complex project as a team drastically boosted our professional skills. We also recognize that effective communication and accountability are absolutely essential when delegating complex tasks among team members. The project also highlights the importance of group meetings, which, as a record in our mini meeting, were vital for professional progress and ensuring alignment across our various research efforts. Overall, this case study has sharpened our analytical skills and broadened our comprehension of the real-world implication of accounting standards. It also truly highlighted the significance of constant learning and adaptability in the ever-changing context of financial reporting. So that's all from us. Thank you.